Hi, I'm Amar Reganti, fixed income and global insurance strategist here at Wellington Management. I'm joined here today with my colleague Ravi Anand, head of private real estate credit. Ravi's going to talk to us about his asset class, trends within it, his own personal work experience, and the opportunity set for insurers and other investors. Ravi highlights our growing private investing franchise here at Wellington. So with that, Ravi, thanks for joining us here today.
Thanks, Amar, for having me.
Okay, look, real estate investing, private real estate investing, this isn't a new asset class. And in fact, to many insurance companies, they already have rather significant holdings in real estate. Some of our numbers indicate it can be for life cos up to 14 or 15% of their risk assets. And a lot of that is already skewed toward commercial. But we keep hearing continued interest in the asset class. Could you talk about what's particularly exciting about it, the work you do, and why you think that interest continues to remain robust?
Yeah, look, as you know, I've been a lender for most of my 25-year career in real estate in particular. The US CRE credit market has grown to over $6 trillion, which is larger than most asset classes, continue to be dominated by banks. As a private lender, I think it's attractive to continue investing in commercial real estate loans. This is because what I call regulated lenders, banks are part of that cohort, are rebalancing, reallocating, and in fact, redefining their operating model in this asset class. There's a continued paradigm shift that should favor private lenders, but I caution anyone who's a new entrant has to have scale, longevity, and a long-term perspective in mind.
Do you think non-bank lenders have an advantage or approach the space differently than, let's say, regulated entities like banks?
Yeah, I think regulated lenders have a box, right? Regulation defines a box that they can operate within. And for private lenders, the box can be a ton more flexible, yet finding great value because they're unconstrained in some manners.
Yeah.
So I think that's the big fundamental difference between regulated lenders and private lenders.
Well, what trends are you seeing in private commercial real estate today, and what are the recent and current market conditions that you think make it interesting? Because we've gone through a period of extraordinary volatility across public and private sectors.
Well, first, there's been a sharp repricing of commercial real estate assets. Obviously, with the onset of the rate hiking cycle, there's been a steep decline in values. Candidly, real estate assets have across sectors down 10 to 25%. We haven't seen that in other private markets. So I think one great aspect of being a lender in commercial real estate loans today is your entry point, your basis is intrinsically lower than the long-term value. So there's a ton of margin of safety. Secondly, I would say there's been a secular shift well before 2022 and the rate hiking cycle in the way we live, work, travel, and certainly the consumer. In a post-COVID, increasingly digital world, I believe that the role of real estate and how we use it will need to evolve as well, making it a particularly interesting time to be a transitional asset lender. Whether it's the need for more logistics or industrial space for the Amazons of the world to get goods to your door faster. Even if you consider groceries, you need more cold storage. And then if you think about the repurposing of older assets, whether it be an office into apartments, we've seen now oversized hotels into student housing. There's this interesting time to be a transitional asset lender more than ever before.
I hear valuation buffer. I hear secular shift. You mentioned, three things. What's sort of the third dynamic?
Well, I think it's the supply-demand imbalance. I think that's the third dynamic. If you think about it, not just today, but since the onset of the GFC, the regulations that have come to bear, we're seeing banks, one, consolidate.
Yep.
And two, we're seeing that they are more inclined to be more senior in the capital stack, is to adhere to their capital efficiency. So they're doing a great job of managing their capital efficiency and being relevant, and we think they'll continue to be relevant. But there's something to be said about going slightly deeper in the capital stack, taking larger exposures to some larger loans. Banks are constrained by just total hold size, as an example. And then making loans on assets that have some level of business plan execution, some level of repurposing, value add. There's more safety, candidly, in our opinion, my opinion, in that sector than in the traditional box. In fact, there's greater alignment amongst borrower and lender.
What parts of the CRE market or sectors or geographies do you find the most compelling today?
I think the fundamentals across most sectors remain strong. If you consider housing, whether it be free market rentals, student housing, senior housing, there's a very large universe to lend against. And then there's sectors that are catering to the digital economy, whether it be industrial, data centers for sure. But I would suggest even certain types of retail and hospitality could be compelling. When you consider, again, the way we live, the way we shop, the way we travel is changing. It's changing rapidly. So for us, it's not as much as a focus on certain sectors or markets. I mean, the universe is pretty large. It's more about a focused interest on well-located assets that are being reprogrammed, repositioned, upgraded. Again, we call these transitional assets that are the most compelling to lend against.
So, in your own experience, and I think you have a long experience working with insurers, why do you think that, from your perspective, they find it so compelling?
I love speaking with insurance companies because they have a long history and they're sophisticated in the sector. I think the opportunity for insurance companies is to diversify away from just core assets and invest in these transitional profiles for these higher earning assets. And I think the challenge likely for existing franchises is likely their own regulatory framework, and or that those franchises don't have the sourcing capabilities and the resources to manage such loans.
It's funny you say that. I feel like the market over the last several years has really evolved to be a little bit more insurance-centric, whether it's rated feeder notes or collateralized fund obligations, or the fact that many transitional loans would be rated CM2 or CM3. Really does seem to be sort of a meeting of the moment for insurance companies in the asset class.
Yeah, I agree with you. When we speak with insurance CIOs and management teams, they're more and more inclined to work with private managers to source such loans, so long as they can do it meaningfully and efficiently.
Well, look, I look forward to seeing your deals going forward. I think this is going to be a fascinating time for you and your team.
Thanks, Amar. Appreciate it.
Ravi, thank you for your time and a really fascinating discussion. And stay tuned for the next Insurance Quick Take.